Good afternoon. Welcome to the midweek update. I felt that it was imperative that we did this today because the market is it looks like it wants to shoot up. I mean, if you look at the NYSE, it's forming these beautiful basin patterns, kind of inverted head and shoulders. And then you have a lot of different stocks as well. And then at the same time, we have quite a few layoffs. We have 13% of workforce at Meta, 10% at Salesforce, 6% Alphabet, 5% at Microsoft, 1% at Amazon. And then we also have all these tech earnings that are coming in, and then the supply chain issues, margin pressure, consumer sentiment is extremely weak. So what is CapEx and ad spending going to look like? So I think this comes back down to the budgets of last year of Q4. And I think the budgets are implying, if you look at the market, that they didn't do anything radical. And so if you look at the NYSE, it's at 15,851. It's looking great. You look at the DAX, it's looking great as well. So it looks like these corporations structure themselves such that the market is, I mean, corporations, if they drop their guidance, the market will follow that guidance. So it's all about guidance for the corporations. And I think their guidance in their budgets, realistic or not, is quite aggressive. It's presuming the Fed's not going to come in and raise rates in the second half of the year. So that's what's going on. If there is any sort of inkling that rates are going to go up the second half of the year, this market will get obliterated. Absolutely. It'll be wild to watch. Yeah, so the play right now is you either a trader, you're in and out, you're being nimble, or you slowly buying some high quality names. But a correction is imminent at some point in the next 3 to 4 months, I would say, based upon the internals, the advanced decline lines. They never have misguided me. And so there's a fundamental multiple cross currents. You have the corporate guidance cross current. You have the market, which is trying to lead the corporations even to a new high, following what they're saying, but they believe like things are even more bullish. And then you got the Federal Reserve on their side. But there's a saying, don't fight the Fed. And when you fight the Fed, you lose money. And what is the Fed doing now? It is raising interest rates. So be cautious, be safe. This market could shoot up, get slammed down. Whoosh. I mean, it's going to be fun next 4 or 5 months. Be ready. And I'm creating this buy list, the watch list. I've been doing it for a while, and it'll continue to grow. And for those of people who think what I actually think is going to happen, I personally think we might get a rally here and then push down, the shorts hit, and then we get squeezed out on the downside. There's just too many people bullish right now, and usually the trade goes the other way when it's like that. Short term, I'm talking. Long term, I think there's amazing valuations out there where you could pick up mining and metal companies, the oil companies, the shippers at extreme discounts. There's some in healthcare as well, or the pharmaceutical industry. And I mean, I've looked a little bit in tech, but not too much. Some in the semiconductor. But yeah, so there's opportunities, but it's in certain sectors. So the weighting of the S&P 500 will start to change over the next 5 years to be less tech and more energy, metals, and material. That's where you want to be. That's follow the easy money, go with the flow, and you will be protected. If you like what you're hearing, subscribe, and I appreciate your time. Green Bicep out of here.